From Peter Schiff to billionaire Ray Dalio, numerous prominent figures in finance have suggested or outright predicted the downfall of the US dollar. Today, questions surrounding the stability and future of the US dollar have become increasingly urgent. Are countries abandoning? Will it collapse? Are we about to lose our global influence by forfeiting the world's reserve currency status? To address these concerns, we must begin with a bit of historical context. The US dollar has been the world's reserve currency since the Bretton Woods Agreement in 1944. This agreement pegged the dollar to gold, while other world currencies were pegged to the dollar. Essentially, the United States was given control over the global financial system, and that is no exaggeration. Holding the status of the reserve currency enables a country to wield significant influence over global finance, trade, and economics. It has allowed the U.S. to borrow money more easily, run trade deficits, and exert considerable economic power internationally. Over the past 80 years, the U.S. has not only enjoyed this status, but also exploited it. Many people criticize economists like Peter Schiff for their persistent predictions of economic collapse. And to some extent, these criticisms hold merit. However, Schiff's main argument, which I refer to as the dollar abuse theory, remains crucial. Historically, every empire that holds the reserve currency begins by using it responsibly. Over time, however, power often leads to corruption, resulting in the currency being misused. The U.S. is no exception. Whether it takes 1 year, 10 years, 100 years, or even 1,000 years, empires tend to fail when they misuse their currency. This might sound abstract, so let's delve into the specifics. One of the primary ways the U.S. has misused its currency is through quantitative easing, QE. Think of QE as a drug that temporarily alleviates symptoms, similar to alcohol. Over the past 20 years, the U.S. has essentially outlawed recessions by masking them with this economic alcohol. Whenever there is economic trouble, the response has been quantitative easing. This term might sound complex, but it essentially means printing money to buy government bonds and other securities. This increases the money supply, leading to inflation and devaluing the dollar over time. We can observe the extent of the Federal Reserve's asset purchases by examining the total assets graph published by the St. Louis Fed. Despite the graph being titled Total Assets, it effectively shows how much money the U.S. has printed. Following the 2008 recession, the Federal Reserve's assets increased dramatically, multiplying by 9 times compared to pre-2008 levels. If that isn't startling enough, the period after 2020 shows an even more significant surge. In less than 2 years, the Federal Reserve essentially tripled its total assets, taking its intervention to unprecedented levels. This isn't the only factor that supports the ideas proposed by people like Peter Schiff. There's also the issue of government expenditures and national debt. Government expenditures have skyrocketed in recent years, driven by significant spending on economic stimulus and public services. According to the Federal Reserve's data, total federal government expenditures have increased substantially, particularly following the 2008 financial crisis and the pandemic. One major consequence of this growing debt is the rising cost of interest payments. As the debt grows, so do the interest payments, which are projected to become a significant portion of the national budget. If current trends continue, we may soon find ourselves in a situation where a large part of our budget is dedicated solely to servicing the debt, leaving less room for essential programs and services. The Peter G. Peterson Foundation conducted a study projecting our future trajectory, and the results are alarming. In 2023, the federal government spent $58 billion on interest, a 38% increase from 2022. If this trend continues, interest costs will soon become one of the largest categories of federal spending, potentially outpacing expenditures on education, research, and infrastructure combined. According to their analysis, there is a structural mismatch. Previously, deficits and debt increases were linked to temporary events like war wars and economic crises. Now, persistent deficits are due to a fundamental imbalance between federal spending and revenues. Simply put, the government spends more than it brings in. The Congressional Budget Office projects that this gap will widen, with federal spending expected to rise significantly as a percentage of GDP by 2054, while revenue growth will be much slower. Many people ignore this issue, but it's a massive ticking time bomb that boils down to two choices. We either cut back on spending, which would require politicians and leaders to make tough choices, cutting programs, increasing taxes, and essentially scaling things down. For an elected leader who is in a 4 or 8 year term, this strategy doesn't align well with career objectives. Imagine your congressperson publicly advocating for increased taxes, cuts to Social Security, a decreased defense budget, and higher interest rates. That would be political suicide, but it would be the long-term solution. Instead, what we are likely to see is more money printing to pay off these debts, leading to more inflation and a larger gap between the haves and have-nots. Politicians tend to focus on short-term gains, which creates an environment where we're constantly printing money for short-sighted ideas that please the public. This can lead to a severe economic situation known as a debt squeeze. You can hear billionaire investor Ray Dalio discuss exactly this in an interview with FinNews. It's a detailed explanation, but it's relevant to our discussion, and what he says at the end is quite shocking.
And so, what do you think will happen in the U.S. with the debt problem? Is there going to be a turning point where there's going to have to be a reset, or do you have confidence that the politicians are going to figure out a way to get out of the situation, or where do we go from here?
I think that we are going to encounter a debt squeeze, and the question is how long it's going to be before there is the selling of bonds by the owner. So let's say,
and just for those when you say debt squeeze, what if you could just explain what you mean by that?
well, that debt service payments by the government is going to increase, and there'll be a need to deal with that, while at the same time the government is selling a lot more debt. And what that means is that we're going to see squeezes in the budget deficits. So they're going to either deal with issues like entitlements, very big political issue, entitlements, or they're going to encounter that kind of debt squeeze in the best case possible. Debt squeeze means, they can't increase the budget, and they have to decrease the budget. And when we're dealing with the geopolitical world that we're in, that means you can't increase the defense budget, you can't increase other forms of spending, climate, and so on. So the squeeze means you either cut that down or you have to print a lot of money. The question, as I say, the second part of that question, that's the best case scenario. The worst case scenario is that they actually sell too much debt relative to the world's desire to buy that debt, which is a real risk because a lot of the holders of that debt have lost money in that debt. And they're also in other countries. And those in other countries are increasingly concerned. They're concerned about sanctions. So a number of these countries could be sanctioned. Sanction means that their debt holdings are frozen in much the way that Russia's were frozen. You could see that concern in China. You can see it in other countries. So there's not only a fact that they are owning a lot of bonds that have cost them a lot of money, and then they have to buy a lot more at a fast pace, but there's also those geopolitical concerns. And then there's concerns in other countries, like there are concerns at home, about how things are going in the United States, how we are with each other, how we're managing the situation. The political aspect is important. If those things lead to then the selling or not buying enough bonds, then what that means is that interest rates go up. In other words, there's not enough demand relative to the supply, and rates rise because it curtails, that rate rise curtails private borrowing. And that would mean an economic weakening would take place because the interest rates rise. That would put the Fed in a very difficult position because the Fed would then have to choose about buying those bonds, printing money. And where do they get it from? They print money and they buy the bonds, printing money and buying that bonds to hold those rates down, which is why I mentioned the two things. That's called quantitative easing. And so if we see quantitative easing and you see that kind of behavior, then a big red flag should rise, and one should realize that there's a real risk of the big leg down in the value of money and debt.
This is Dalio's worst fear, and given the current trends, it's a legitimate concern. Thank you for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it. And let me know in the comments below if you think a debt spiral is a possibility during our lifetimes here in the United States.